Welcome, everyone. I'm Rick Bensignor, and this is In the Know Trader. This week's show will review the key markets like we always do, and we'll also have an educational segment to it, as I'll start to introduce some of the institutional models we use in our analysis. As a reminder, I created In the Know Trader to bring you, the individual investor, access to models and the thought process that professional money managers and traders use when making their investment and trading decisions. But before we start today, I've got two quick announcements, kind of what we would call housekeeping type things. Next week in our show, I'll be interviewing Jeffrey Hirsch, who's head of the Stock Traders Almanac. Now, the Almanac was started by Yale Hirsch, his dad, some 50 years ago, and remains one of the street's important resources for historical patterns in the market. Make sure you tune in for that next Tuesday. And also, number two, I'll be speaking at this year's Orlando Money Show on Friday, February 8th, and making two different presentations. One will be a morning one for about 45 minutes introducing behavioral finance theory, which, as you may or may not know, is the street's hottest topic these days. More and more companies are investing significant resources into behavioral finance, which is essentially the combination of psychology with classic economic models, and discusses the importance of combining psychology with economic models to see how human beings actually make decisions as compared to how classic economists think we do, which is typically in a very rational form. But heck, we're humans, and we tend not to make rational decisions with some frequency. So I'll be doing a morning show, a morning presentation at the Money Show for that on Friday, February 8th. And then the second presentation I'll be doing in the afternoon is actually what they call a Masterclass. This is a 3-hour class, and it'll be run around how to build a successful trade, really from start to finish, what you need to do to line up a trade from the very beginning, and walk you through the whole process, including how to set targets, how to set stops, and also really kind of learning from yourself how to know when you need to get out of a trade that's simply not working. And that in itself is probably the most important piece to all of that, because if you can determine early enough that what you thought was going to occur is not happening, almost always you will save a significant amount of money if you act then and exit your trade, as compared to hanging on and hoping that it'll come back to do what you thought it would. There is a place and time where you kind of know it's just not going to be, and I'll advise you on how to act upon that. So that's the 3-hour session at the Money Show in Orlando. That is the one of two largest individual investor conferences there is this each year. One's in Orlando, one's in Las Vegas, run by the Money Show. And if you can get there in Orlando in February, it's from February 7th to 10th. I'd recommend you get there. So let's start looking at some of the key markets today and see what's happening. So we're going to start off, as we often do, with the S&P 500. As I've mentioned before, this is the benchmark for institutions. Really, people on Wall Street do not look at the Dow Jones. That is more of an individual investor type index, and what, of course, the network evening news typically reports at night. But honestly, it is the S&P 500 that more portfolio managers are benchmarked to than any other index, and therefore that's what we tend to concentrate on. As this is the way the street looks at the market. So we're going to zoom in a little bit onto this chart. So let's make it a little bigger. So If you see my arrow up here is all-time highs back in early October. You can see we had sold off, obviously, till right around Christmas time, and then we've had the bounce since. So I put a flash note out to clients earlier this week saying that the easy money has been made on the upside in this move, and that we're getting closer to the beginning of some very significant resistance levels. We labeled it from 2,600 to 2,645 as the initial kind of, let's put that at almost 2% area, starting at 2,600, that we would expect to see fairly good resistance and potentially a pullback from. Let me just walk you through a few of the different indicators that you're seeing here overlaid on the chart, and then in fact we'll probably come back to this chart a little later simply to start showing you some of the models we use besides standard technical analysis, such as moving averages and trend lines and things like that. You'll see there's a variety of other type, mostly horizontal levels here on the chart that come from different type modeling than you're typically accustomed to or actually have access to in charting systems that are out there, especially the free charting systems. These models are not on there. So let's start here. Just the basic downtrend line from all-time highs. Here's this dark maroon line that comes in somewhere here. I don't know, just eyeballing it, probably somewhere around 2680 right now, something in that neighborhood. We have this kind of greenish line, which is an old trend line that we had broken down from. This started from the lows in February this year, and that actually comes in kind of similar territory over the next week or so, as does the downtrend line. So we certainly, I'm not saying that 2,600 to 2,645 has to top the market here, but that certainly is where we would expect to see initial selling. Beyond that is there's kind of two lines here tucked together. It's a little hard to see, but right around here, just north of 2,600, is something called a trend factor. Now, this is part of the modeling from Tom DeMark, and this is a model that you don't have access to other than through viewing it through my In the Know Trader report that I write for my individual investor clients. And we'll talk about this a little later, but one of the things that we're going to talk about are what's called 9 counts. In fact, they're called setup 9 counts, and you'll see there's a variety of them on the chart that you can see. And it's very possible that tomorrow we'll get another one indicating, purely from a timing perspective, a short-term peak in the market. So that's another reason why I think kind of just north of 2,600, we're going to run into resistance. What else do we have here? Well, the pink line here is the 50-day moving average. You can see it caught some of the lows. Let's here, maybe we'll put a little more price data in. So back in August and back in June, it caught the lows of the move, caught near the highs here in November, caught the high again in early December. So, you know, this certainly is a place that we know you might find some sellers too. And look, it's a 50-day moving average, nothing special about it other than this year it happens to have worked decently along with the 200-day, which is the purple colored line. So here on my chart, we're highlighting this purple line. Again, we'll go back in time a little bit, and you can see earlier in this year, the 200-day moving average caught the low back in February, which had been the low of the year until December. The lows here in April, the low in May, pretty darn close to the lows in July, a bounce here in October, and then it kind of started becoming resistance as the market consolidated. So it's now worth about 20, it's at a level of 2741. If we were to go a full 100 points above where I think we will initially, I have pretty strong confidence that something in and around that 200-day will act as significant resistance and that we will not simply plow through it. In fact, from a pure market and economic / political point of view, what we've told clients is that the highs made last year probably will stay the highs, as well as the December low for right now, given the news flow that we have, as well as the most recent vitamin boost that the market got when FOMC Chair Jay Powell suggested that the Fed may very well hold off on bringing up interest rates this year. That helped mark the low. And for right now, again, given the known news and not a material change to either side, I don't really see a reason that the market would go and make a new high this year, certainly not in the first half of the year. And for now, I don't have a reason to think that the lows we saw at 23.45 will be broken either. So given just how large the fall was from all-time highs, we're talking something like 600 or so S&P points in just a couple of months. I think it's fair to say that at least for the first half of this year, very good odds that we stay in between those levels, again, barring some exogenous event or something that changes this, most especially to the downside. But that's kind of the way I look at things now. So again, initial resistance 2,600 to 2,645 or so. It could expand past that, but I think that especially given the fact that tomorrow may be a setup 9 count, and all we'd have to do here, I'll actually give you the price that we need to do, assuming today holds its rally. If tomorrow closes above 25.90, roughly 25.97, no, that must be, 25.97. So it's touch and go because we're right near there now. We could get that 9 count and potentially a short-term high, similar to how we saw, here, let's, similar to how we saw highs here in November and a high here in September on that same kind of 9 count. So again, I'll explain that in more detail a little bit farther into the show, but that is something that we're watching closely and gives us a clue what's going on. Let's take a look next at the U.S. dollar. If I can find it, where do we have? There we go. So here's a daily chart of the U.S. dollar index starting in mid-November. We had advised clients to, again, these are institutional clients, to get out of all trading longs in the U.S. dollar north of 97.40. The high of the move is 97.80, and now we're trading down near 95, looks like 77 or so. So this has been a good call, at least for as much as a 200 point down move in the dollar, or a full 2 round handles, 200 pips, as you would say as a foreign exchange trader. Notice too, and we can take a look at this again a little later, that the bottom occurred on the same 9 count. This 9 count, in fact, helped call the bottom, whereas in the S&P, the chart we just looked at, it's potentially helping to call a near-term top tomorrow. So this 9 count helped call a bottom there. It helped call a bottom back here in August. Here, let me try to highlight that. So right in here, it helped call a bottom. You had a little near-term top here in October for a week-long pullback. This 9 count did not call a high. It did for a very short time. And then ultimately, we got these 13 counts, which are all part of the model too. And this is a Tom DeMark sequential model that helps call exhaustion of trend. And it fits very nicely into my general way of looking at markets, because I tend to fade moves rather than go with trends. To me, I'm doing this, as I've explained before, over 35 years, and no doubt in my mind that you make the most money when you can figure out when a trend is going to end, as compared to just simply playing a trend that already exists. Because the risk here, take an example of an uptrend. Just picture this in your head. You have an uptrend. You go, oh, the trend is higher. Let's play with the trend. At any given time, you could get a pullback in the trend and you get decent drawdown. Decent meaning not particularly good. You get some significant drawdown. That's perhaps the better word to use. And yes, you're long in an uptrend, but if your timing was off in actually buying within the trend, you could face some significant drawdown on that position. Playing for turns is much more difficult, but at the same time, if you can do it, you can exit trades on or near the highs of the move, get into trades near the lows of the move, and then as they start going the way that you're positioned for, other people in the marketplace start catching on to the fact that these something's starting to look like a trend, and then they jump on board, helping to fuel the profits that you're already in. So, as I mentioned, I tend to look at exhaustion of trends as compared to looking to simply play the fat part of the bell curve, the statistical bell curve within the trend itself. Here's also the dollar index looking slightly longer term. Now, this was interesting. So if we go back to the fall of 2016, and let's kind of target this vertical line here, just about when Trump wins the election, the dollar flew for the balance of 2016. And one of the most significantly mistimed and mispositioned calls for the bulk of Wall Street was that going into 2017, people were radically long and bullish the dollar because of Trump's victory. Well, we had seen the almost 2-month move from elections into December 31st, 2016. And as you can see from this chart, 2017 was a disaster for the dollar. The street had it completely wrong. We actually see a very nicely formed 5-wave move down that I've labeled in green. And as we hit the 5th wave, I guess about a month and a half later or so, I get this sequential 13 signals suggesting downside exhaustion to the trend, and we turned long the dollar at very close to 2018's low and wrote it well above the 94 handle. And then you can see this weekly chart has this setup 9 count very close to the top in the fall, and that lined up with the 13 signals that, again, part of this 9 model is a further count to 13. And that helped us call the top to the dollar, at least for now. Right now, we are neutral to the dollar. We've sold off enough to think that short term, it has declined enough so that tactical traders who had shorted the dollar north of 97.40, as we suggested, are now covered, and we're kind of flat. So that's our view, at least initially now, on the dollar. Let's also take a look at the bond market and bonds. Oh, by the way, here's a chart within the fixed income arena of one of the credit spreads I look at. This is the LQD ETF, which is the investment grade, the most traded investment grade, corporate investment grade ETF, versus the Lehman 7 to 10 year index, and IEF, which is that Lehman 7 to 10 year index, is the closest thing you can trade to the US 10 year bond. So it's not a perfect match to the 10 year, but it is the closest instrument you can trade if you're not trading 10 year futures. But in the ETF world, that's what matches up. So let me widen this out a bit, give you a little more history here, and show you. So going back to 2008, right? Obviously, the credit spreads, hold on, let me get the scaling on the chart here too so you can see the far side. Give me 1 sec to adjust this. Here we go. So as the world was falling apart in 2008, we see the credit spreads come way in, and then they, of course, recovered. And then we sold off again in 2016 when the market sold off strongly. And then we've sold off again in credit spreads. Over actually all of 2018 was a decline in the credit spreads. And if I put up the combo model, which is a sister model to sequential, you'll see that we've got as low as a 12 count. We're really as close as a week or 2 or 3 away from potentially having the bottom in the credit spreads too. Initially, look, there's a little head and shoulders in here. We broke down, and there's this triple top across the bulk of 2018. We've sold off. We're getting closer. You know, we had put out this downtrend line as our target, but from a timing element, we see here that we're getting closer. So that also is part of the reason why I think as we get closer on narrowing credit spreads, that the stock market itself is likely to stabilize in here, and why I think the low that we saw right around Christmas time can hold for now as the bottom. And then the last thing I want to show you is the let's see if we have well, here's TNX on a daily chart. You know, you have the significant double top at 3.25%. We got down to 255 on the lows to start the year and have bounced. And my call for this year that I've told institutional clients is I believe the bulk of the year U.S. 10-year yields will trade between 2.40 and 3.0%. We can get a little movement on either side of that, but as I say, the bulk of the year should trade within that. So I think the closer you get to those extremes, the more you kind of have an easier, more defined trade to put on. So we got to 255. It was still 15 basis points away, but we clearly kind of made the low, at least for now, at the beginning of the year, and we've bounced since then. So anytime we get down again to test the low or break through it, you know, I'm essentially a seller of bonds, thinking that yields will go higher. And if we get back towards 3%, maybe as much as 307 or so, I'd be a buyer of bonds looking for yields to come down. So I kind of see this year as kind of a consolidation of last year's bigger move. And for right now, I don't see us going above the 3.25%. We've got a little more than 5 minutes to go, so let's take the opportunity now to, again, kind of get into this little educational segment of the show. And we can even start here just even looking at the TNX chart. So what I want to do is, here, I'll just so it's easy to see. Where I've circled here this 9 count, I want to kind of pay attention. I want you to see what form this count. This count comes from, again, this was a model developed by Tom DeMark. Occasionally you'll see him on TV. He is one of the very significant institutional consultants on the street who built upwards of 75 different trademark models that he makes available to institutional clientele. It is possible to buy these yourselves through, for instance, this charting system I have here, which is CQG. It is not an inexpensive package of models. So again, it's potentially available, but it's thousands of dollars a year to have access to these models. But I pay for them. It's part of what I use for institutional clients, and it is part of what I use for in-the-know trader clients because, as I said, my goal in establishing in-the-know trader was to give public individual investors the same type of access to models that institutions use, and why institutions are often so successful at what they do. So this is a timing model. Let's go back here to on the left-hand side. what is this 9 count? How is it formed? Well, it's a pure mathematical relationship that says this is a period of 9 consecutive price bars. This happens to be you'll see up here, this is a daily chart. So this is 9 consecutive days that the closing price, and you might want to scribble this down, the closing price is greater than the close from 4 bars earlier. So you don't have to have 9 consecutive higher closes. You need to have 9 consecutive closes that are each greater than the close from 4 closes earlier. If any time along the way you don't close above the close from 4 bars earlier, the count drops off. But when it reaches 9 consecutive bars, it's often a short-term peak. Or in this case here, you'll notice 10-year yield sold off 9 consecutive days that the close was less than the close from 4 bars earlier. This happened to bottom on bar 6. Here's bar 9, but you still did get a 10 basis points move up. You then sold down and did another 9. Here's a 9 bottom. This 9 did not help at all in calling a top. Here's a 9 also that just paused a few days before selling off again. Here's a 9 that got a small rally. I tend to like to look at 9s for short-term potential flips. Now, again, not everyone works, and I'm not saying they do. But this is a model that institutional clients use as one of the ways of being able to identify potential turning points in a trend. In the bigger picture, this count, which is called the setup count, this 9 count, is really just teeing up the eventual end of a trend, which is called the countdown, which is the 13th bar. And you'll notice that in this case, 13 is in red. So here's how this works. We're going to have to finish this quickly. I'll continue educating you this along the way as we go through shows. After you do a 9 count, the mathematics change looking for the ultimate end of the trend. It then looks to count 13 different bars. In the case of a setup that has moved down, it looks for 13 bars that the close is less than the close from 2 bars earlier. And when you do this 13 times, and they do not need to be consecutive bars, so if you notice here, as I widen this out, there's plenty of days that don't have a red count. Here's bar 9, for instance. Why is this not bar 10? Because this close was not less than the low 2 bars ago. But when you eventually get to a 13 count, it often calls the end of a trend. It did so here on the bottom. And it called virtually the high of the move in bonds last year. So here's a 13 count that didn't call a bottom. So again, it's not always going to work, but this is a model that I want to expose you to. I will continue to expose you to as we go through shows. That's it for this week. Thank you for tuning in. I'm Rick Bensignor, and now you're in the know trader.
Here's how to put a simple line on your chart without using the annotation tool. Let's say we want a line in here at 47.50. You can just drop down here into the overlays, pick horizontal line, add the price point, 47.5, and we're going to use a red line. We're going to make it solid and thick and hit update, and that blasts it into the middle of your chart.